For centuries, the financial markets have looked like just pure chaos, right? A frantic storm of numbers, news, and noise. But what if I told you there's a language hidden in all of that? A story that's being told not in words, but in the price itself. That's the core idea we're going to dig into today, the philosophy behind technical analysis. So, that really gets to the core question, doesn't it? Are the market's day-to-day movements completely random, like flipping a coin over and over again? Or are there actual patterns hiding in there, patterns driven by human behavior that we can learn to spot and understand? Well, technical analysis is the tool that's designed to do exactly that. And here's our official definition. At its heart, technical analysis is the study of market action. And what that really means is just the raw data the market itself gives us, mainly price and how much is being traded. The whole goal is to use charts to read the story this data is telling us and hopefully get a better sense of where the price might be heading next. Okay, so before we dive into any specific patterns or indicators, we really have to get a handle on the philosophy behind it all. Because without that, honestly, the charts are just a bunch of meaningless, squiggly lines. Yeah, and let's get one thing straight right off the bat. This is not about fortune telling. A technical analyst, or a technician as they're called, isn't trying to pull a prediction out of a crystal ball. The real goal is much more grounded. It's about getting an objective snapshot of the market's collective psychology, that balance between greed and fear as it exists right this second. The amazing thing is, this entire field, this whole discipline, it really just rests on three powerful core ideas. If you can wrap your head around these three beliefs, you'll understand the logic behind pretty much every chart you ever see. All right, so here they are, the big three. Number 1, market action discounts everything. Number 2, prices move in trends. And number 3, history repeats itself. Simple, right? Well, let's break down what each of these actually means one by one. Okay, this first one, it's the big one. It's the absolute cornerstone of the whole approach. What this means is that pretty much anything that could possibly affect a price, we're talking earnings reports, political news, a change in investor mood, it's all already baked into that number you see on the screen. The price is the final word. It's the summary of everything. And just think about that for a second. The implications are huge. If everything is already reflected in the price, then all you really need to study is the price itself. It kind of becomes a shortcut to understanding all those other complex factors. So you're not digging into the why, you're focused on the what. You're studying the effect, not the millions of possible causes. All right, number 2. This one is absolutely key. The entire point of charting is to find a trend when it's just getting started and then, ride it. The idea is basically Newton's first law of motion, right? An object in motion tends to stay in motion. Well, same goes for markets. A trend, once it's established, is way more likely to keep going than it is to just suddenly reverse. And boom, take a look at this chart. It's the perfect example. This isn't just a random series of up and down days. You can clearly visually see a persistent uptrend in the S&P 500 that went on for years. The main job of the technician is to spot a direction like this and trade with it, not against it. And that brings us to our third and final pillar. Why do chart patterns that people spotted 100 years ago still seem to pop up today? It's not magic. It's because they're basically just pictures of human psychology in action. The core emotions that drive markets, fear, greed, hope, panic, those things are constant. They don't change over time, so the patterns they create tend to repeat themselves. So to really get a handle on what a technician is all about, it's super helpful to compare them to the other major camp in market analysis, the fundamental analyst. Now look, both of these analysts, they're trying to do the same thing, figure out where prices are going to go, but they come at it from completely opposite ends. The fundamentalist digs into the cause. They're looking at things like economic data or a company's balance sheet. The technician, on the other hand, says, hey, all that stuff is already in the price, so they just study the effect, the price movement itself on the chart. All right, so we've got the philosophy down. Now let's get to the single most important concept in all of technical analysis. Seriously, if you only remember one thing today, make it this: the trend. Everything revolves around the trend. So, what is a trend, really? I mean, it's more than just the price is going up. It has a super specific definition, and it's all about those peaks and troughs, the zigzags you see on a chart. An uptrend is just a series of higher peaks and higher troughs. And a downtrend? You got it, it's the opposite. Lower peaks and lower troughs.
And here's what that looks like in its simplest form. Over on the left, that's your classic uptrend. Every peak is higher than the one before it, and every little dip or trough is also higher than the last. On the right, you see the downtrend, lower peaks, lower troughs. This super simple visual logic, it's the foundation for, well, pretty much everything that follows.
Okay, that's the textbook version. Now, let's see it play out in the real life. This chart brings those simple diagrams to life. You can clearly trace the market moving through three distinct phases. First, a downtrend with those lower lows and lower highs. Then it goes sideways for a bit. And then a brand new uptrend kicks off. You're literally watching the market's story unfold. Right, so what actually creates those peaks and troughs that make up a trend? Well, this brings us to two huge concepts, support and resistance. And the absolute easiest way to think about them is as floors and ceilings in the market. So support is the floor. It's a price level where buyers step in and say, nope, not going any lower. And their buying power is strong enough to stop a price from falling. And resistance, you guessed it, is the ceiling. It's the exact opposite, a price level where sellers take over and say, that's high enough, stopping a rally in its tracks. The troughs form at support and the peaks form at resistance. Okay, now here's where things get really cool. There's this amazing principle called role reversal. Basically, when a price smashes through a resistance level, that old ceiling, that same level often turns into the new floor or the new support level for any pullback that happens later. And would you look at that, a picture-perfect example from a real NASDAQ chart. The price breaks through that peak labeled prior resistance, it rallies, and then, a year later when it pulls back, where does it find support? Right at that old ceiling. The old ceiling became the new floor. It's just an incredible real-world demonstration of that market psychology we've been talking about. Okay, so as we start to wrap this up, it's really important to tie all of this back to that central theme. We're not just drawing lines on a screen here. What we're really doing is mapping out human behavior. Look, at the end of the day, technical analysis is not some magic formula. It's a framework, a disciplined way of observing and trying to understand the collective mind of the market. Every line, every pattern you see, it's just a visual record of that constant tug-of-war between buyers and sellers, between our collective greed and fear. And that really leaves us with one final big question to chew on. When we're looking at these charts, are we actually seeing a roadmap to the future? Or are we just looking in a mirror, a reflection of our own unchanging human emotions playing out on this massive global stage?